Good morning, everybody, and welcome to today's webinar. Today's webinar is Academies Finance Update, and it's a sunny Thursday morning, just what you need on a Thursday morning, isn't it, really? Just to get us started, we've got some usual housekeeping points. Hopefully you can all hear me well, but just in case, please jot down the telephone number on the screen, the access code, and the webinar ID. You can dial in using your mobile phones if needed be, just in case there are any audio issues today. Fingers crossed there aren't any, but you never know with these things. So just quickly jot down those numbers just in case. We are a live webinar. We are doing this from broadband. So obviously we can have technology issues. Fingers crossed we don't have any technology issues this morning and we're all okay on that. So we have to just pray that we're all good to go. You are more than welcome to ask any questions during the webinar. There is a chat function box on the right hand side, should be on your screen now. Please write any questions in the chat function. I'll try to answer the questions at the end of the webinar. It's very hard for me to answer them during the webinar. Being a typical man, I can't multitask. I'm useless at things like that. It's very difficult clicking buttons and speaking at the same time, never mind trying to answer questions and read them. But I will try to answer as many questions as I can at the end of the webinar, assuming we've got time to do so. Regardless, I will come back to you if you have asked a question. You are more than welcome to drop me an email at any point. My email address is on the screen now. Feel free to drop me an email if you've got any questions about the webinar or anything whatsoever. We can come back to you as soon as we can once you've sent that email. As I've mentioned, we do record these sessions, so they will be circulated afterwards to everybody in attendance today, and the slides will follow as well. So you've got them for your records, and any links that are embedded in there, you can see where they are, and you can download and follow those links if need be. So for those that don't know me, my name's Alex Makinson. I will be your presenter for today's session. One of my areas of expertise is Academy Trust, Academy Schools. I've been dealing with academies since inception. I act for a significant number of schools and trusts sort of across the area, really northwest into Shropshire, down to the Midlands and all that sort of things, really. So I'm sort of one of the experts we have at Mitchell Charlesworth, hence why I'm talking to you today. A little bit about Mitchell Charlesworth. We do have a few people that actually are on their first webinar with us today. So a little bit about who we are on the screen here today. Our offices across Chester, Liverpool, Manchester, Widnes, and how we obviously are at the forefront when it comes to dealing with academy trusts and all the proactive stuff that we do, including things like this webinar, really. Now I'm going to keep you for around about 45 minutes, depending on how I get on today. I did do a few sessions this morning and it's around about 45 minutes, but you know what I'm like. If you have been on one of my webinars before, I do have a tendency to overrun just a little bit. Please forgive me for it, really. I like to make sure that I give as much as I possibly can to you during the session here, but hopefully we should be done in around about 45 minutes time. Now, we have a packed agenda for you today. We're going to talk about post-audit outcomes. We're going to move on to the 2020 benchmarking report, a little bit on trust growth, and then the DFE plans for academies, going on to procurement, and finally, just to wrap it up, we'll talk about some updates and reminders just as they come along right at the end there. So let's get it started, really. The first item on the agenda is post-audit outcomes and the common issues this year. It's been a number of months since we did the audits. It's a number of months since you've done your audits, since you've had your auditors in, the accounts have been prepared. We've relaxed, we've had a few months off in the sense of not having to deal with the audit and the accounts. And we've just got into our usual habit of dealing with our monthly accounts now rather than the statutory audit and all the rigmaroles around that. So this is just a little bit of a summary over some of the issues that have arisen during the audit, some of the common themes, some of the things that people got wrong, some of the problems that we saw and the sector has seen this year in relation to those accounts and those audits, to see and to make sure that obviously you don't fall foul of those issues come next year. So the first thing to speak about today is the supplementary bulletin. You'll know full well that we obviously have the Academy Accounts Direction that gets issued every year. This is the second year we had the supplementary bulletin. It wasn't the first year, the second year. And it's actually quite surprising how many trusts failed to notice that bulletin and failed to include all the items that were included within that bulletin within their statutory accounts and obviously within the audit as well. So let's just quickly just run through those items that you should have included that we saw and the sector has seen, unfortunately, weren't great, weren't included, were omitted totally, or a bit wishy-washy, should I say. So the first thing to talk about is the trustees report. COVID was absolutely everywhere in the trustees report. You should have actually included COVID on virtually everything within that trustees report, from how did you engage with employees, so the impact on your staff, the impact on any meetings you actually had, the impact of outcome of children's. Every section in your trustees report should have had a couple of lines, possibly even a paragraph in places, depending on what's gone on in relation to COVID. Surprisingly, when that came out and when the department reviewed the trustees report, they felt that the COVID report of the COVID impacts were somewhat light, and in most places not even there at all, really. And the supplementary bulletin was quite descriptive over what it expected when it came to COVID, which areas it expected you to comment on, and what it expected you to say there. So they're a little bit disappointed in relation to the COVID items within the trustees report. Then on the same thing, when it comes to COVID, we obviously had the COVID income splits this year coming in, and you'd be surprised at how many people actually didn't split the COVID incomes between the DFE and non-DFE funding. So in other words, if you're a trust that actually did have furloughing, so if you had some nurseries and potentially furloughed some staff, which was allowed for nurseries there, and then you obviously had your usual COVID income coming in, maybe your catch-up funding, then they should have been shown separately. You'd be surprised on how many trusts did report them under one column, not two. They should have separated them out between DFE, Department for Education COVID income, and non-DFE, in other words, other government income when it comes to COVID. Some of the other things when it comes to the COVID notes weren't, I'm afraid, right. For a lot of trusts, the narrative and the COVID funds was missing on a lot of schools' accounts. That wasn't shown. You were obligated to show what balances you had carried forward in relation to your COVID. So you catch-up funding or something that wasn't spent that you carried forward in relation to COVID. They should have been shown. There should have been a bit of a wording at the bottom about that. They were unfortunately excluded or removed and just not shown in a number of trusts' accounts. Again, your COVID fund note should have been included, and they were not. Some of the interesting things which were not shown or were missed when it comes to the accounts and the audit. You may recall that the department did give away a lot of laptops during COVID over the last sort of 18 months, 2 years. And what should have happened with those laptops is they should have been brought in as income, a donation in the accounts, and then the other side being the fixed asset introduction. A lot of schools, a lot of trusts just forgot to do that transaction totally, and therefore did not bring in any of the laptops that they were gifted, that they were given. There should have been obviously that transaction, that double entry, that income when it comes to those laptops as a donation to the trust in your SOFA, in your income details, and the opposite entry being the balance sheet to recognise that you've got a load of laptops given to you. And this isn't just laptops that were donated through the Department for Education. This is laptops that were donated from anywhere, really. So if you did have a laptop scheme where you invited businesses to come in and give you some laptops or use laptop to help you through the last 18 months, 2 years or so, then they should have been shown as a donated asset as well. Unfortunately, a lot of those were missed, and that's quite common for the accounts and the audit that we saw for this year. You should have all known that we had some updated ESFA, can't get my words out this morning, detailed breakdowns in the accounts. Upon reviewing some accounts ourselves, we found that those breakdowns, sadly, were not undertaken. Universal Income for Fiscal Meals pupil premium should have been broken down its entirety this year, not summarised. They didn't happen, I'm afraid, for a number of accounts. Same thing when it comes to the grant funding split. You should have split those as well. If I move on to some of the technical bits, when it comes to the accounts and some of the things that we found that were wrong, not right, or just not included at all, really. These are the three main areas that we found as auditors. And when I say we, it's not just us, it's auditors in general here. Trade union facility time. Anybody with more than 49 full-time equivalents employees over a 7-month period, don't ask me why it's 7 months, not a year, have to include trade union facility time. A lot of trade union facility times were not included. Obviously, if you do not have any trade union representatives, you can state that in your accounts, but you do have to state that. That was excluded for a lot of trusts where it should have been included. So naturally, you have to disclose your number of employees in the accounts. So if you disclose your number of employees of being more than 49, but you haven't got a note in your trade union facility time, then obviously something's been omitted in your accounts. The energy and carbon reporting is the next one. Everybody hates this one. It's in the trustees report. It's for all those trusts with more than £40,000 worth of 40,000 more kilowatt hours in a year. You have to disclose your energy and carbon reporting. It's a horrible calculation. Some trusts just didn't include it. Some trusts got the calculations completely and utterly wrong. What I would suggest for people to do going forward is keep a note of all of your utility bills, copy them, have them separately saved in a folder or something on your systems so that you can easily start generating that note come the end of the year rather than having to do it frantically at the end and getting it wrong. And sadly, a lot of trusts have got that note wrong, declaring their energy and carbon reporting amounts. Then we've got the large trust reporting. Now, I'm going to mention the large trust reporting a little bit later on, but a lot of that reporting was excluded. So this is where trusts have grown, and as a result, they are obligated to disclose more information because they are much larger. A lot of that information, sadly, was omitted, failed to be put in the trustees report and the accounts whatsoever, I'm afraid. So there's a bit of a negative tick on that one. I'll go through some of those items a little bit later on during the audits. You know exactly what you should be including if you're a larger trust. And what is the definition of a larger trust? Because there are two clear definitions when it comes to larger trusts, depending on what you're disclosing. Some of the regularity issues, I put audit issues here, but I probably should mean regularity issues here. Common issue in regularity this year was compensation payments. Now, I'm not talking about staff compensation payments. I'm not talking about staff severance. Academy trusts do seem to be very good in disclosing the staff severance payments, and everyone seems to understand the rules and regulations around staff and what you do have to obtain ESFA approval for. What trusts are not very good at doing is disclosing non-staff payments. So compensation payments in relation to payments to third parties. And what you have to do in the accounts is put £5,000 and the reason and rationale. When I say £5,000, I mean anything above £5,000 has to be disclosed, and the reason and rationale over why you've made that payment. Alcohol, a common theme again this year. It's not the first year alcohol has been in there. I think we're on our second, if not third now, when it comes to alcohol purchases. We all should know that alcohol purchases are not allowed. There are some slight exemptions to that. Obviously, if you're a church school and it's used for religious purposes, that is allowed. But on the whole, alcohol purchase is not allowed. That's a regularity issue. If you have purchased alcohol in the year, it will lead to a regularity report qualification and a notification. And unfortunately, a few trusts this year have fallen foul of that rule and bought alcohol for one reason or another. And I know it's an easy thing to do, bit of a thank you bottle of wine to somebody, or dare I say at a party or something, and some alcohol's been bought there. I'm afraid it's a flat no when it comes to these things. I don't write the rules, we just have to report on them. The next item is related party transactions. I always bang my drum on related party transactions, and it's still here. It's still a major problem with audits, with the regularity report. Less so when it comes to following the at-cost rule. I think we're all understanding the at-cost rule now. More than £2,000, it has to be at cost. Less than £2,000, there can be a profit made by the third party. So that's not an issue. The issue now seems to be the disclosures. The issue now seems to be the notifications. So either it's not disclosed in the accounts because, oops, someone forgot to notify the auditors of it, or it's a matter of we forgot to notify the ESFA, or even worse, depending on the amount, we forgot to wait for approval from the ESFA before engaging with that related party and transacting with them. That falls foul of the regularity report issue, and therefore we've got a few regularity reports being noted this year with regards to the Academy Trust audit in relation to academies and related party transactions. So it's still a big topic, still going on. People are still getting caught out, I'm afraid, when it comes to related party transactions. Just know they're still there. And if you are worried, ask, read the handbook, have a look at what you have to do. I think at the end of the day, really, the department are saying we don't want related party transactions. They are making it really hard, really difficult for you to engage with related parties, with trustees, with senior management team here. They'd prefer you not to engage, but we know sometimes you do have to. The last item on this section is transfers in and out. There's a lot of consolidation going on in the sector. There's still a few conversions, and I'll talk about conversions to academies in a minute. There's a lot of consolidation, there's a lot of trusts merging together, there's a lot of ins and outs, so a lot of schools being transferred out to other trusts and schools coming into trusts as well. And within the financial statements, there should be a full note on all of those transfers in, not just the conversions, so any transfers in and out of your trust in the year, and all the details around it, not just the values. Sometimes we have what we call fair value adjustments. In other words, the value in the accounts is X, but in reality it's worth Y now. And those disclosures, sadly, are either not there at all or incorrect, and that's been found. And I think what's happening now is as the sector is consolidating, as we're seeing lots of movements between schools, and as schools sort of grow, this note is becoming more and more frequent and is being looked at a little bit more by the department and by auditors, and therefore we are spotting that things are right within that note. So that's the sort of overall audit summary. I think the points are getting less and less every year when it comes to auditors. It's making our job a little bit more difficult to try and find issues. That's a good thing for you. We don't want to find issues. We're not here to try and pick fault. We're here to try and guide. I think we're getting onto some of the technicality points when it comes to the auditors now. You're learning what is going on with the audit. The sector is now starting to develop. It's no longer new. You know what you're doing, and therefore it's tiny little points that are coming out of the audit now rather than major regularity issues. And I don't think we're seeing that many fully qualified audits that we used to see many, many years ago. Moving on to the next section, which is the 2022 Academies benchmarking report. Now, we at Mitchell Charles are, I think, one of about 3, possibly 4 firms in the UK that produce an Academies benchmarking report. So it's not that every accountancy firm does it out there. There are only a few, to be honest. And this is our 2021, so sorry, 2022 report, which is the period ending 31st of August 2021, so the most recent set of accounts. And you can download a copy of our report free of charge. There's no charge for it. You don't have to put any details in at all. On our website, please make a note of that, although they will be on the slides a little bit later when we distribute it to everybody. And you can see our full report there. Now I'm going to cherry pick 1 or 2 pages from the report. I could talk to you all day about our benchmarking report, talk about all the highlights, the variations, what's gone up, what's gone down, what we're seeing across the sector. I'll probably bore you to death if I did that, and it would take all day. I'm just going to cherry pick on 1 or 2 little things I think you may be interested in, and feel free to go download the report and sort of benchmark your own schools at your leisure. So let's talk about the key highlights that this year within our report. I'm going to try and make this a little bit bigger. So I'm going to actually scroll into certain things here, and you'll hopefully see this on your screen in a second. So this is our 10th report. We've got 300 trusts being represented in this report. That's not all of our trusts. That's just the number we chose to do this year. Over 1,500 schools. So it's a good sample. It's a good basis. It's large enough to see what is going on in the area, and it's large enough to enable you and your schools to benchmark against other trusts. Now, unsurprisingly, COVID is featured quite significantly in our report, because we know it's been an interesting time this year. It's a second year of COVID when it comes to the financials, and we've got impact on COVID all over the place when it comes to schools. But there are some quite surprising impacts on COVID, which I think you may or may not be surprised about. And I'm going to draw your attention to the bottom part of this slide. I'm going to try and make it bigger as well so you can see, which records and shows the surpluses that we are seeing across different types of trusts. So multi-academy trusts, secondaries and primaries are shown here, and the surpluses at the end of the year across 3 years. So it's looking at a sort of 3-year trend. And I'm going to take you from the right to the left here. So you can see the average surplus carried forward for multi-academy trusts at the end of 2021 was £467,000. It's a sizable figure. It's a large figure. I appreciate there might be many schools within a multi-academy trust, so we have to take the figure with a bit of a pinch of salt at the moment. The interesting thing is what's happened over the last 3 years. If you look at the 2019 figure, that was just shy of 200,000. So it's more than doubled over 2 years. It's more than doubled during the COVID period. Why? Well, whilst certain schools have lost trading income, they've lost before and after school clubs, they've lost renting out certain things, sports halls, those sort of things. Actually, there's been significant cost savings elsewhere. Big ones, supply, utilities, facilities, as we mentioned in our benchmarking report. That has resulted in a lot of trusts showing in-year surpluses and actually more carried forward surpluses as well. If I take you into the middle one, secondaries, they've gone up 147 last year, 155, and it was a mere 13,000 in 2019. So what is the difference? The main difference has been COVID over the 2 years, and they've got a huge increase in their surplus. Primaries on the left-hand side have bucked the trend a little bit. They have dropped down in 2021. So 2020 was 25,000, the average surplus for a primary. That's dropped down to 14,000, still higher than 2019 at £12,000 there. If I take you to the right-hand side of this slide, and I talk about trust deficits, you can see what's happened with trust deficits. 8.2% in 2019 showed a trust deficit. Here we are now in 2021, and only 3.8% of trusts are showing a trust deficit for the year. That's a significant drop in the trust deficit. That means our in-year surpluses across those 2 years. So whilst everybody thought COVID was going to have a major impact on finances, and we thought there was going to be a squeeze on budgets, we thought there was going to be a lot of deficits this year. The reality is, benchmarking across the board, and I appreciate there will always be outliers, there will always be people that show surpluses and people that show deficits. The reality is, on the whole, there's been a drop in surpluses, and it's been a drop in deficits and a growth in surpluses. A little bit surprising for a lot of people, that one. If I move on to the second slide, and I will take you through this one. The positives here, as I've mentioned, just on that top bit of the screen, fewer in-year deficits, a large increase in reserves, cash balances seem to be higher for schools there. They're all positives, impacts over the last year or so. What are we also seeing? We're also seeing that trusts are looking to grow again this year. And I've got a few more details on trust growth a little bit later on, so I'm not going to labour that point. We've got an interesting point in the centre here, which is centralisation. Right at the start of trusts and multi-academy trusts, and as they grow, there was lots of the finance function being dealt with at individual schools levels. There wasn't this centralisation. There may have been a CFO, there may have been not. We are now seeing the vast majority of trusts having a centralised function when it comes to their finance team. 97% is a huge amount when it comes to trusts being part or fully, I appreciate there's a part caveat in there, or fully centralised. We are seeing that an awful lot more now. We're seeing less done on a school by school basis, less financial functions happening in schools, more being held centrally, more being done at one location, whether that's at one school or whether you've got a separate area that does that. It does seem to be the norm now that there is more centralization of the financial function. Now, it's not all good news. Some good news about fewer deficits and higher reserves and higher cash. Unfortunately, there are some bad news coming. We all know it's been a difficult year when it comes to staff resources. We all know that staff have been working really, really hard, and that seems to be continuing. The feedback we've had from our trusts has been that it's a very, very hard year coming when it comes to staff on the back of COVID and the impact, and trying to resolve all the issues because of it, trying to bring, obviously it should be, in spite of the extra funding that's come along. And then we've got horrible little things coming, if I try and move this to the left, over energy. Now, we're all worried about energies in our homes, and obviously we've seen a massive increase. There will be a massive increase at schools. We know there's a certain cap in place for schools at the moment. That will have to be raised. It can't continue. That's going to have a squeeze on budgets going forward. We'll have to see what happens with that one. Moving on now onto financial measurement within our Academy benchmarking report. A common question that I get asked when I present accounts is Alex, we're expecting a deficit or we're expecting a surplus, but when you present the accounts, the figures are completely different. And often trustees and sometimes even school business managers and CFOs find it difficult to sort of to transact between their management reporting and the statutory accounts because of the accounting adjustments, because of things that your accountants and your auditors produce and put into the accounts, which change the figures significantly. So you'll see on the screen here is an extract of one of our trusts, really. It's an example from one of our trusts, and how you really should take your financial statements with a little bit of a pinch of salt, because it may show a completely different scenario to what is actually happening within your Academy trust. So if I just talk you through this here. So we've got an Academy trust, a multi-Academy trust here. It's showing an in-year deficit on the SOFA, £600,000. The trustees are getting a little bit nervous, going, oh gosh, we've got a large deficit here, 600,000. What have I got to do? Have I got to restructure? Have we got to make some drastic decisions here, because we are reporting a large deficit in the year? But the reality is that figure includes lots of accounting adjustments, non-cash adjustments that we are showing within the accounts. And we've put that in the slide here. And those adjustments, depreciation is the most obvious one, where we show that obviously the assets have dropped in value. We pull that in. You've got your pension service charge, a horrible figure that goes in there. This is not the amount of money you pay into your pension scheme. This is the amount the actuarials charge you and they take off your scheme. You don't see that figure. It doesn't cost you money. It doesn't cost you pounds, shillings and pence out of your bank account, but they do take money from the pension scheme, and we have to show it in your financials, and it goes to increasing that deficit, really. And obviously the final figure, the 150,000, is taking out capital items, in other words, SIF grants, DFC, something like that. So you can see from this trust scenario, actually, they started off, according to their SOFA, with a huge deficit causing potential concern, 600,000. They've gone into a £450,000 surplus once you add back those three items. So you do have to take these things with a little bit of a pinch of salt and understand exactly what is going on within your financial statements if you have any concerns from your trustees. Moving on now into trust deficits and what this is showing us. And I've got two charts at the top here just to show you a little bit more about what is going on with trust deficits. and how COVID has had an impact on trust deficits. This is the in-year deficit, so this is year-on-year deficits. So around about 38% of trusts were showing in-year deficits. That was very consistent over 3 years, 2017 to 2019. And lo and behold, when COVID hit, 2020, 2020, we've dropped significantly. We've gone from 38% down to 19%. Now, I appreciate trusts obviously don't want to report deficits. They do everything they can to balance their books, but we had consistency and now we've got significant drop. If we look on the right-hand side, if I move this over, you will see that cumulative deficits has dropped as well. So the cumulative deficit overall has dropped over the last 2 years quite significantly, from 8.2 in 2019 to 3.8. That's a significant drop in cumulative deficits when it comes to those trusts that are reporting deficits. Now, if you're one of those trusts that are reporting surpluses rather than deficits, so deficits you don't care about because you're a very good trust in the sense of you managed to balance your books and you haven't got any concerns about deficits, well, look at the bottom table and you can actually see what the average surpluses are. So for 2021, the average surplus for a MAT, £467,000. That does seem a large amount of money. The reality is you've got some large MATs in there. You've obviously got a number of schools within there. You could have primary, you could have secondary. So £467,000, whilst a lot of money, if you've got 20 schools within there, if you've got 5 schools in there, it can be a lot of money really. From a primary and secondary perspective, average for secondaries, 155,000, and average for a primary this year, £14,000. So they're the average surpluses that we are reporting in our bank. In not just individual MATs joining, we are talking about growth and consolidation of trusts now. So you can see on this slide the average number of schools per MAT has grown significantly over the last 5 years. We've gone from 4.5 schools within a MAT to now almost double that. Now getting to 7.5, well, a little bit less than double there. But it is growing quite significantly over the years, and that continues to happen. Now, I'm going to launch a bit of a poll now, so there's a bit of interaction now between you and I here. If you've used my polls before, you know what to expect. If you are on an iPad or an iPhone listening in today, unfortunately, I'm afraid the polls don't seem to work. They do work if you're on a computer. Fingers crossed they'll work for you. My team in the background will launch the poll in a minute, and I'm just going to ask a question, which is your trust looking to grow? And if so, by how many schools? So have you got an agenda this year? Are you actively looking to have some more schools within your trust? Is it a no? No, you're happy, you're consolidating, maybe you've taken on a few schools, you just want to see where you are, you're trying to focus on those schools because maybe there are high schools or schools that need improving there. Or are you a trust that's actually actively looking to grow, actively looking, and if so, by how much? 1 to 3, 4 to 6, 7, and I think you will be surprised when I say 4 to 6 and people go, well, that's unusual, you wouldn't take on 4 schools. Well, there's lots of consolidations. As I said, you might have 2 4-school MATs joining together to create 1 8-school MAT. That's a consolidation. So just quickly click on the one that you think is appropriate for you if you can. I'm just going to leave it open for a couple more seconds. 3, 2, 1. Hopefully you've all managed to click on the link if you wanted to there. And my team will hopefully now show the results. Okay, right. Well, I think that result speaks for itself, really. The main focus is 1 to 3. A lot of you out there are saying actually we are looking to grow. We're looking to add 1 to 3 schools within our trust, 65%, 6% 4 to 6, and then 29% saying no, we're not, we're consolidating, and unsurprisingly, naught saying 7 plus. So we're just going to close that poll now and just see whether that poll today mirrors what our benchmarking report says. And if I show you the lovely little chart at the bottom, I think it does sort of mirror what our benchmarking report is showing here, which is around 35% of trusts are not looking to grow. They're happy, they're consolidating, maybe they're large enough for the moment, they've got enough to deal with. 54% are looking to add 1 to 3 schools, and then you've got 4 to 6, 6.5%. So I think that poll sort of mirrors what we're expecting here, which is there continues to be a lot of growth in the sector. On the whole, it's 1 to 3, but that little bit at the top, that 6.5% is growing now. That is getting larger and larger every single year because we've no longer got a 2 or 3 school mat adding 2 or 3 more schools. We've got that mat to mat consolidation. That is becoming more and more frequent now, where a 4 school mat becomes an 8 school mat by joining up with another mat. Moving on now to our top slicing report. I get a lot of questions about top slicing, especially with smaller mats with a sort of 2, 3, 4 growing, starting to establish themselves in the market as such, and about top slicing. How do they pay for all their central services? How do they collect enough money to cover all the costs that they've got to do centrally? If they're wanting to engage and employ a CFO, a CEO, a COO, how do they generate their money? And as you can see from the top part of this slide, the vast majority of individuals and trusts are still using a percentage of income. 73% this year has increased ever so slightly from last year, 72%, but 73% are still using a percentage of income to calculate that their top slice. Now, the million-dollar question is percentage of what income? Now, a lot of people go percentage of GAG, but that is changing. It's not just a percentage of GAG. It could be a percentage of GAG plus all your other income. It could be a percentage of GAG plus income, but excluding certain income, i.e. excluding SEN, excluding pupil premium, excluding universal infant free school meals. It's quite important to establish what income we are talking about because it doesn't just mean GAG. And every school is different, every trust is different, so it's what is right for you. But the vast majority of trusts are still using that percentage of income to calculate exactly what their top slice should be. You will see there has been a move away from a time apportionment. That's dropped in half this year, and there has been a slight increase in other. You're probably wondering, well, what's other? That is flat rate normally. That is, we are charging an amount of money across the board to cover all of our services. We know what our services are. We know how much money we need that rate across the board for them. But if we talk about the top slicing percentage, that's 73% of trusts. Well, what rates are they using? And I'm just going to try and make that section a little bit larger on my slide here. The vast majority of trusts, sort of 60% now, are using an average 5%. Now, I mentioned a few moments ago, 5% of what? 5% of income, but what income? Because 5% of GAG can be very different from 5% of GAG plus all your trading income, really. We have got a few trusts at the top level, not many, 8% mark, that's huge. A number at 6 to 7, but that does seem to be dropping ever so slightly, and a number obviously at 4% or lower. Now, what you're actually finding is a lot of the smaller trusts are keen to entice schools to join them. How do they do so? Is to provide a lower percentage basis. They need more schools to join them to generate more income into the central service pot because it's economies of scale here. And therefore, they are often going for a lower GAG rate to entice people in. But the norm we are seeing still is around about 5%. And I think the vast majority of trusts are applying that 5% rate to their schools. Moving on to GAG pooling. Now, I'm not sure whether you've all heard of GAG pooling. This is where instead of your GAG coming in and saying it's for school A, B, C, and D, The GAG comes into central, and central effectively allocates the income accordingly to schools based on their individual needs. So that GAG is pooled by central services rather than being allocated to the individual schools. And often you find then that any reserves are pooled in central as well, rather than having individual schools reserves. Now, it has been around for a significant number of years. It's not new GAG pooling, but it does seem to be an upward trend. And you can see that on the slide here. 14% of schools or trusts are now GAG pooling, whereas a couple of years ago it was only 5%. Now, 14% is still a very low figure. It's not the majority of trusts, but it is starting to bite. It is starting to build momentum, and trusts are now looking into GAG pooling more. And that's a nice way of obviously having all of your reserves in one pot rather than having this them and us scenario when it comes to individual schools. Some other areas covered by our benchmarking report. We've got governance, we've got mental health and well-being, which is quite important over the last 2 years. We've got board compositions, math centralization, income and funding analysis, so you can actually have a look and see, are you generating enough income? How do you compare to other trusts? How are they generating more income? Are you better, worse? Why? How? Looking at your costs, how your costs compare to other schools, to other trusts, as well as some of the balance sheet items. Do you have more money in the bank compared to them? Do you have more capital spend? Do you have more capital assets? And that dreaded pension, how does your pension figure compare to other trusts here? So all of that is contained within our benchmarking. You can see all of the individual figures, just download the report, see whether it's worthwhile having a look at. Some of your trustees may be interested in that, you may not be there. Moving on to sort of trust growth is the next section. Now, I'm talking about the financial element of trust growth. I'm not going to talk about the educational element of trust growth. I'm not a teacher. My experience lies in the financial aspects of academy trusts, not the educational aspects. But I always mention trust growth because it's a big topic at the moment, because trusts are growing. It seems to be a big push from the Regional Schools Commissioner. They're no longer happy with 1, 2, and 3 school trusts. They want 1, 2, and 3 to become 4, 5, and 6. They want 6 to become 8, and that's definitely the direction of travel that we are seeing when it comes to the sector. Now, I've mentioned due diligence a number of times during some of my past seminars, and it's one of those old cliches. You'd never buy a house without engaging a solicitor and carrying out a number of searches, just to make sure that house is effectively not suffering some subsidence or built on a coal mine or something like that. So why would you ever take on another school, ever join another trust without undertaking due diligence? That is the checks. That is you looking at those schools or school and deciding, yes, these are the risks, these are the issues, this is what we need to consider, this is what we need to be aware of. Are we still happy to proceed based on this? And you're surprised, or I'm surprised, over how many schools are taken on without significant due diligence undertaken. And maybe somebody just going, well, I've looked at their reserves, they've got some reserves carried forward, so I'm happy. I'm afraid that's not good enough. You should be undertaking full due diligence on a school if you're taking on them, or if you're joining another trust, then you should be taking on your own due diligence on that trust to make sure that they are financially sound. And it's not just about certain numbers, it's about the implications of certain things will have on a school, i.e. what happens is your Ofsted report drops from outstanding to good, and you're surrounded by lots of other outstanding schools. Does that mean actually children and parents might go to different schools? That could have an impact on your income. What happens is your staff profiling is very top heavy and you have lots of UPS teachers. What happens is your pension scheme is significantly underfunded, and therefore you've got some large pension costs coming if you've got a conversion of a new school joining your trust. These are the things you should be checking. There's a whole host of things you should be checking. Now, who should be doing that due diligence? It really is up to you. You might have some very competent CFOs. You might be competent in doing so. There's nothing to stop you doing it. You're very experienced yourselves. Yes, you can engage an expert to do so if you wish. It is your choice, and it all boils down to time, effort, and cost, obviously. As trusts grow, they unfortunately fall foul of missing certain things they need to do. One of the most common ones that we see is gender pay gap reporting. If you're a larger trust and your head count is more than 250, then you must report on your gender pay gap reporting. That is reported every single year. It's as at the 31st of March, reportable by the 30th of March the following year, and there's a website to report it on, and then you must obviously have a written statement. That's the most common one we come across when trusts start to grow and you have a head count of more than 250. I'm talking about head count, not full-time equivalent here, very different. Things that you need to look out for as your trust grows. Obviously, we're talking about the financial aspects here, and we're talking about the accounts. I mentioned trade union facility time. So if you're a smaller trust and you're growing, so maybe you're going from a 1 to 2, then obviously trade union facility time needs to be included. If you are a trust that's growing with more than 250 employees, you're not deemed a large trust at that point, you're deemed a large employer. And therefore, you have to include engagement with your employees within your account. You effectively have to have a policy on engagement with employees to show and to tell everybody how you engage with employees, and that has to be reported within your financial statements, and you should have that aside within your records as well. And then we get on to engagement with suppliers. Now, this is for large trusts, slightly different from large employees. You'll easily be caught out by this, because what you can find is you're a large employee, but not a large trust, or potentially vice versa, would you believe? Now, the definition of a large trust is 2 out of 3 here for 2 years, so turnover 36 million or more, balance sheet 18 million or more, employees 250 or more. There. So that's 2 of those 3. So if you tick two of those 3 boxes, you are deemed a large trust, and you have to report on your engagement with your suppliers. So again, it's a policy over how you engage with suppliers, and you have to include that within your trustees report, amongst other things, in your accounts. One of the other things you must do is report on your success as a trust. Again, that's just for large trusts. So you can see as your trusts grow, as you become a large employer, i.e. more than 250 employees, and as you become a large trust, there are lots of little extra things you need to be aware of and you need to do. You need to be happy with drawing these things up and not falling foul of not doing them. Some of the common areas when it comes to trust growth that you need to consider, and some of these are very obvious, to be honest with you. Centralization. When you're a smaller trust and you start growing, centralization becomes a very hot topic. You need to think about it more. Where do you need all of your support services? Should it be in one place more than the other? Do you need to have a CFO if you haven't got one? Do you need a dedicated finance team? Should they be at the individual schools? Should they be centrally in one place? That's a decision for you. But as your trust goes, these things should always be reviewed. I've mentioned top slice before, so I'm not going to mention that again. Gag pooling, something that obviously is on the agenda for a lot of people at the moment. And then pension pooling. I'm going to come back to gag pooling in a moment, and I'm going to launch a poll in a moment, but I'm going to mention pension pooling before I do that. Pension pooling is something that trusts forget about. This is where actually you can pool all of your end of year certificates as an example. So if you've got 5 schools and you have 5 end of year certificates, that's 5 lots of work, 5 lots of end of year certificates, 5 lots of tests that your auditor has to do. You can consolidate those certificates into one, and therefore it's one lot of work, one certificate. It saves you time, it saves money. Equally, you can actually pool some of the pensions as well. In other words, we're talking about the actuarial report and we're talking about your pension payments. It can be beneficial to pool your pension rates as well. These are things you should consider if your trust is growing and as your trust grows. Now, I'm going to launch a poll now about gag pooling. And I'm going to ask a question on gag pooling. So hopefully my team behind me are going to launch a poll now, and you can click on it. Is your trust currently considering gag pooling? Yes, no, or already do it. I'm just wondering whether, of the people that are present here today, is it something that you're considering or not, and or are you already doing it? I think I know probably the answer, but I want to see what your views are. So I'm just going to leave that poll open for a few moments. So I'll give you a few more seconds just to click on the link there. So 5, 4, 3, 2, 1. Can we just close that poll, please? And can we share the outcome? Okay, so, okay. Surprising, 17% of you are already gag pooling at the moment. So that's a fair chunk. 50% no, you're not considering it. And 33% are. Well, if I put the yes isn't already doing it, that's a 50-50 split there. A little bit higher than I expected. I expected more no's, but I think that represents where gag pooling is now. It's on an upward trend. A lot of trusts are considering gag pooling now. They're getting away from individually funding schools to gag pooling and then allocating the money accordingly based on needs. Thank you very much. Can we close that poll? Brilliant. My team are working very hard in the back, clicking all the buttons. I have the easy job of just talking. Moving on to plans for academies. You may have noticed that the department were brought up in front of the Parliamentary Select Committee recently and spoke to MPs about where they thought the sector was going, what was going on, whether there's going to be any proposed changes. And there was some interesting comments made. I'm going to share one or two of those comments with you. So they mentioned that the RSC system, the Regional Schools Commissioner system, may be changed. We may get some new regions, bringing in line with the regions that sort of we expect. That means we're going to have some more individuals potentially. Some people like Regional Schools Commissioners, others, well, I'll reserve judgment, don't there. They do seem to work. And obviously they encourage maths to grow, and we may see some more regional schools commissioners going forward. They commented on the impact of COVID and how it's affected academy conversions. And you can see that on the screen now. We had 908 conversions to academies in 2019, only 474. That's a significant drop of academy conversions, and they're putting that down purely to COVID. There were some very interesting comments about mixed secondary and primary trusts. Now, there was some biting of tongues, I could see. There was some on the fence comments being made, but there was a very which was that secondary schools need to demonstrate that they understand and can effectively run primary schools. So we're talking about mixed trust, we're talking about secondary trust, trying to encourage primaries to join, or we're talking about existing mixed trust secondaries with primaries. And I know we all have our own individual views when it comes to these things, but there was a clear comment on the effectiveness of primary schools. And I think possibly there's a worry that primary schools can often be seen to be lost within a secondary math, and that secondary math shouldn't be losing them, and they should be demonstrating that they know how to run primary schools if they are leading that multi-academy trust, because obviously secondary schools are normally a lot larger when it comes to individual primaries and comparing the two. So I thought it was a very interesting comment made by some individuals there on secondaries taking on primaries and having mixed maths. A couple of other things mentioned. The SRMA is going to be extended for another 3 years. That came out some time ago, but it was mentioned again, and how the department really likes SRAs. There's some white paper coming out. There's a white paper coming out, would you believe? Now, this is what is being proposed. This is what we believe is being included. Obviously, when the white paper is published, we will know, we will see, and we'll understand exactly what is being told in that white paper. But there's an expectation that there might be some suggestions all academies, all schools will become academies by 2023. That's not that far off. Now, we had obviously forced academisation a long time ago, and obviously that was then changed. This sounds like forced academisation again via a different route, but there's certainly a direction of travel across the department that they wish all schools to be academies by 2030. There is a huge focus now on faith schools. There is effectively 4,000 faith schools, and they want those faith schools to convert. They are encouraging things like the diocese to actually create their own trusts, to encourage faith schools to convert, to encourage faith schools to join and to convert to academy status there. And that would leave 8,000 other schools remaining. The vast majority of the are primary rather than secondary. And an interesting point at the bottom there was even a consideration going to be made for council-run maths. Now, to me, that's just a local authority, really. But that is focusing on those areas where, in local authority areas, there is a significantly low uptake in academy conversions, whilst in other local authority areas, there's significantly high uptake in academy conversions. So they're focusing on those areas where actually the councils maybe are providing great services to schools, and those schools are really happy with their council running them or controlling them, and therefore allowing their councils to create maths and run maths, and then technically all of the schools there would be converted to academies regardless. I'm going to move on to procurement here, but I'm also conscious of time. We did say an hour here, so I'm at 45 minutes or so, sorry, 55 minutes. So I'm going to whiz through this as quickly as I possibly can here. There has been some changes on procurements. Why? Well, we came out of Europe. Brexit wasn't that far ago. We sort of lost it because COVID came along, really, and sidetracked us. That changed the way procurement happened. We didn't have to comply with all those EU procurement thresholds when we came out. There was a transition period, but we no longer have to do it. But there are rules and regulations around procurements. In other words, purchasing. And there are certain thresholds that schools should be doing things with. I'm going to categorize them into three. Anything over 40,000, that is a guide, not a set figure. You should do certain things. Anything between 10 and 40, that's a medium threshold. You should do certain things, and below 10 is a different threshold here. And it's all covered via the public contract regulations and procurement thresholds. Now, if you are over £40,000, you've got to do lots of things, and lots of things that are on the slide will not be unusual to you. Assessing the market, invitation to tenders, using restricted procedures, but you must use the DFE recommended framework tool that will guide you into certain areas when it comes to doing purchases. It might guide you to the Crown Commercial Services site, for example. It might guide you to buy air conditioning units from a certain supplier or suppliers. That should be used. What must you then do then? If you're purchasing over £40,000, you must use the find a tender service. Now, there's certain things that you have to do when it comes to tendering. You have to assess bids, choose suppliers for best value of money, assess them in accordance with some sort of scoring criteria that you set. And all those details are in the guidance that I put at the bottom there. We still have it referred to as the EU procurement threshold there, even though the EU is not relevant there, but all of those thresholds still apply here. If I get on to the medium areas, so we're talking 30 to 40 here, strange enough, a lot of these things are the same as the previous slide. That find a tender bit drops out, but you should still use the find the DFE approved framework. You should still follow that, and you should still follow all of the other items on procurement for items that are between 30 to 40,000 pounds. When we drop down onto what I call the low items, or anything sort of below 10,000 there, then this is very straightforward stuff here. We're just talking about 3 suppliers. We're talking about assessing tenders and quotes here, the things that you do every single day of the week there. So that was a very whistle stop on procurement because I'm a little bit short of time there. Forgive me there. If you want any further details on the procurement thresholds and what you should do, just click on all the links. We'll send the slides around there, and you can see exactly what you should be doing. And do follow those links, because you would be surprised in the find a tender and the DFE frameworks. They do try to guide you, and some of those suppliers on those links do offer best value for money. Just moving on now onto cybersecurity and updates and reminders rather than cybersecurity. The final agenda item, updates, reminders, and the first item on this is cybersecurity. You may recall that I mentioned cybersecurity in my last webinar. Rather, it's a big area. schools are being targeted left, right, and centre by hackers. We're talking about ransom demands. We're talking about you not being able to access your systems and effectively them saying, give us £50,000 and we'll let you back in again. And if you were on my webinar last time, you will understand that you're not allowed to pay it. You have to apply to the ESFA for approval, and lo and behold, the ESFA has said they will not grant approval for payments of any demands when it comes to these sort of issues. The big change is that there is now cover within the RPA. So if you insure your trust through the RPA, cybersecurity issues, should we say, are covered within the RPA. I'm sure there'll be elements of restrictions there, but I'll give a classic example of one of our trusts was sadly hacked last year. They lost all of their financial information and therefore had to rebuild all of their financial information for 12 months. It was a mammoth task, took hours. You just imagine how much it cost them to do so, where now it looks like such a scenario could potentially be included within the RPA, and the RPA could potentially reimburse certain costs there in relation to the cost of reinstatement. On to a reminder for the Companies House submission. We all get hung up on submitting the accounts to the department before the end of the year or before we go off for a Christmas break, and then we got hung up on the AAR, and now we're talking about other things. Well, please don't forget that you still have to submit your accounts to Companies House by the 31st of May if it's not already done so, and there's a fine and penalty for not doing so. Don't forget that. A few trusts forget every single year, so it's certainly a reminder. Then we got the BFRO, and I put BFRO, but it doesn't exist anymore. It's going, as we put on the slide here. We just have the BFR, and that's going live on the 21st of June, and the deadline the 26th of July. So that's one for the diary going forward there. But I like that we don't have to produce two budget forecast returns. We just have one. Thank you very much. I'm fed up of bureaucracy, and that's one less thing to do. Finally, on this slide, we've got the SRMSAT. What a great acronym that is. You should have done that by the 15th of March. If you haven't done that, you're a little bit late. It should be done. It's not on the name and shame list, so don't be too worried if you haven't done it. But it is a reminder, if you haven't done it, quickly do it, quickly get that submission done. You won't get any raps over the knuckles for not doing it on time, but technically you are late. That was a very whistle-stop last sort of 10 minutes for you there. I'm just over an hour on the webinar, so please forgive me. As I said at the start, I often overrun. That's normal for me. I've got a couple of questions, but given the time, I will answer those questions directly with those individuals rather than keep you any longer. I do hope that you enjoyed that webinar. I do hope you took one or two things from it. Please do download our benchmarking report. Have a good look at that. It's a great document for you there. If you have got any comments, any feedback, anything you want to talk to me about, drop me a line and I'll come back to you as soon as I possibly can. Thank you all for attending today's webinar. Have a nice afternoon. Take care all.